Jerome Powell has lost control of the monetary system, and we are heading for an inevitable crash. But how deep is that crash going to be? My guest on GoldCore TV this week is Michael Pento. Michael is the president of Pento Portfolio Strategies. He's an author, and he's also the host of the Midweek Reality podcast. Michael believes that we could be looking at a crash of anything up to 80%. To find out why it is that he's increasing his gold allocation to 15%, watch this video. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how you can buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. Michael Pento, welcome to GoldCore TV.
Thanks for having me on, Dave.
Now, here's a question for you. Are the Feds so out of touch that there is a risk that they make a significant policy error by raising rates either too far or too fast?
Are they at risk for making a major policy mistake? So they've already made a major policy mistake. They have engendered inflation at 7.5% CPI over the past year. 7.5% is 3.75 times their asinine and stupid 2% rate of destruction of the purchasing power of the dollar. So they've made a humongous policy mistake already. And I'll add this. They've had ample time to rectify it, but even in February, early February, the Fed came out with its plan of how many bonds it wants to purchase between the time of the announcement until March 10th. They plan on purchasing, in other words, adding to the balance sheet, in other words, adding to the base money supply, in other words, adding to the pace of destruction of the purchasing power of the currency, in other words, adding to inflation, $20 billion of treasuries and some unnamed multiple billion number of mortgage-backed securities. So just to be clear, the Fed is still increasing the money supply and adding to inflation, even though it has already exceeded it by 7.5% year-over-year inflation. Bear in mind that they're supposed to be supplying Americans with a stable rate of inflation, not 2, and certainly not 7.5.
So they're still heading towards a cliff, and they're not taking their foot off the gas even now.
It's a beautiful way. I mean, only an Irish guy can come on. That's a beautiful poetic way of saying it. Yeah. So so what would be the reason why they would want to do this? What in the world is the reason why Jerome Powell wouldn't have the guts to at least stop digging a hole, or at least take his foot off the accelerator while he's heading towards this cliff? Well, the only reason I can come up with is because he's so petrified about Wall Street. I mean, who is he protecting? Is he worried that the middle class is being decimated? Is he concerned that first-time home buyers have been priced out of the stock market, of the home purchase market? Is he worried that the equity market is now 2 times, twofold the underlying economy? No, he's worried about keeping asset prices afloat. But he has to choose. This is the truth. The administration, the Democratic administration in the United States under Joe Biden, he cares more about the middle and lower classes than he does Wall Street. I mean, let's face it, 40% of Americans have no stock portfolio at all, and they have no savings at all, less than $1,000, and they rent. These people are being destroyed. These are the people he claims to care most about, and these are the people he's hurting the most of all. So he's going to have to choose, Dave. He's going to have to choose whether he's going to allow inflation to be many degrees higher than he wants it to be, and continuing to price first-time home buyers out of the real estate market, continuing to destroy the purchasing power of the middle class? Or is he going to actually bring asset prices down? He has to choose one or the other. And I believe because of the administration and the pressure that Biden is putting on Powell, he has to choose to at least try to start the fight against inflation. Because if he doesn't, Dave, guess what? If he says tomorrow, I'm really worried about the stock market, it's getting kind of jittery, and we can get into how much damage has been done just in the first month and a half of 2022. It's been pretty bad. The average NASDAQ stock is down like 40%. So what Powell can say, okay, tomorrow, we are no longer going to raise interest rates and we're not going to address the balance sheet. We're just going to end QE. Let's say he does that. Well, he risks the very salient probability that long-term interest rates will just spiral out of control, rise intractably. And then he's going to destroy the stock market anyway, as he also destroys the middle class. So he has to do this inflation fight. He has no choice.
So he has to raise rates.
100%. He will raise rates in March, at least 25 basis points, maybe 50 basis points. He gets one more inflation reading in early March before he has to make that decision. It'll probably be 25. It will be 25 or 50. It will be at least 75 to 100 basis points before July. But the most important part, this is what not many people understand. They don't talk about it because they don't get it, but I do. So I'll share it with you. The Fed has to begin to pare down that $9 trillion balance sheet, which has increased by $5 trillion, almost $5 trillion increase in base money supply, which is a proxy for the Fed's balance sheet, since the pandemic.
So they're going to be selling down assets at a certain stage soon.
They're either going to be rapidly, they could either let these assets roll off, the short-term assets roll off rather aggressively, or they might even have to start selling. The Fed owns $2.7 trillion of mortgage-backed securities, and it wants to get rid of them all. So I don't know how fast that's going to run off is going to be. I don't have the exact order of the Fed.
And what's the reason behind that? What happens if they don't?
Well, if they don't address, like I said, if they don't address the balance sheet and they don't raise interest rates, then you risk the idea that long-term interest rates are going to continue to rise rather aggressively. I mean, right now, long-term interest rates, you look at the 10-year note is hovering around, 10-year note around 2%. So it's 2%, which is up from 0.33% at the nadir of the pandemic. So you've already had a pretty good rise in interest rates, but the reason why they're not rising even further than they are right now is because the market now believes, you look at break-even spreads, which is the proxy for the market believes inflation is going to be. The market believes the Fed is going to undertake this inflation fight, at least to some degree, and help bring inflation back to quiescence. So maybe it goes from 7.5% to say 2 or 3% by sometime in 2023. But the market believes this because they believe the Fed is actually going to take on this fight. If the Fed doesn't fight inflation, if it just puts its hands up and say, all I care about is the stock market, and all I care about is the real estate market, and all I care about is the junk bond market, well, then guess what? Rates are going to rise intractably, and that's going to destroy the stock market anyway. So they really, in my opinion, have no choice but at least feign a very reasonable effort to fight inflation, at least for now, until something breaks, and it will, which will be probably the repo market or the commercial paper market or the junk bond market. When the credit markets freeze, guess what happens? Powell will acquiesce and throw his hands up. But the stock market, due to that frozen credit market, will probably plunge 30% plus while it waits for Powell to raise his hand.
And while they're acting, when they go through this first course of action now, they start raising rates. How do you think that the stock market is going to react? Do you think that it's fully pricing in that now?
It's partially, I would say, I don't know if I put a number on it, 70% priced in the rate hike. Listen, the Fed funds futures market already has 6 or 7 rate hikes in it. I don't think the Fed can get there. I think something's going to break on the way to, 1.5% to 2% Fed funds rate. I'm pretty confident in that. So the stock market is sort of pricing in the majority of that move. But guess what? It's not pricing in what we just talked about. It's not pricing in the quantitative tightening program, which in the Fed's words is going to be very much expedited and rather aggressive. So they're going to be draining hundreds of billions of dollars, probably ending up probably a terminal balance sheet, maybe around 7 trillion. So $2 trillion is going to be the goal. They're going to be probably doing anywhere between 80 and 100 billion per month of sales once that schedule gets ramped up by the middle of this year. And that's where the stock market's going to run into problem. That's when things break, when you drain liquidity from a financial system that's been built on excess liquidity. If you take, the Fed was averaging $250 billion of QE since the pandemic till they're going to end QE. That's going to be the average amount of monthly bond purchases. Well, you go from that to selling, reducing base money supply by $100 billion a month. That's not priced into anything. Something is going to break, and it's going to be the credit market. Stock market's going to plunge. And then you have the question, well, what does Powell do? Now, he's still going to have, an $8 trillion balance sheet. Fed funds rate might be about around 1%. But just going back to QE and lowering interest rates at that point, what does that do for the confidence in the purchasing power of the dollar? What does it do for the confidence in our sovereign debt market? In other words, the Fed is going to say, he's going to put everybody on notice, hey, guess what? We can never drain our balance sheet. We can never raise interest rates, and we can never end QE. So
they become totally neutered. They've lost nearly all their tools. They're no longer in. Have they ever been in control? But they're definitely no longer in control because they've got nothing to work with.
Listen, Dave. That's the consequence of having the hubris and arrogance to think that you're better than markets. That you understand the cost of money. You get it. You don't want a downtick in the stock market. You don't want recessions. You don't want that cathartic recession where bad companies go under and you replace buggy whips with automobiles. They don't like they was up to the Fed, we'd still be typing on typewriters. They want to keep bad businesses, zombie companies afloat. And they've done it so long and to such a huge extent. They've dithered and dallied so long. They've created such massive dislocations in the market that they can never even approach normalcy. Because if you do, the 20% of companies that are now zombies in this country, they go under and people get laid off and the economy crumbles and the credit markets freeze and the stock market plunges. Because, when you're at a total market cap of equities of 200% to GDP, you can't normalize without causing immense harm on the way to that goal.
And when you've mismanaged it then for so long, as you say, like 20% zombie companies, left to its own devices, the market would have eliminated a lot of these companies. And they've literally been put on life support by the Fed, by low interest rates, by quantitative easing. So there's been a buildup of this fat within the system. It'll take an awful lot longer for it to wash out of the system then. So therefore the drawdown, the crash, that period of recession, depression is elongated in that situation, isn't it?
Yes, the depression or the reconciliation of asset prices is going to be protracted and intensified. Right.
So what's the most likely scenario that we're heading into now?
Well, I run an actively managed portfolio. So rather than me tell you where we're going to end up, let me just take you from where we are now, because you're going to have some quick moves in the middle. So right now, we are experiencing stagflation. I think that quickly morphs into something more like disinflation as the Fed begins to raise interest rates and drain its balance sheet. I think at some point in the middle of 2022, this year, I believe we have a battle with outright deflation as the credit markets freeze and asset prices plunge. And then on the other end of that, maybe that lasts for a few weeks or months. I'm not sure how long. It depends what the Federal Reserve does. But on the other end of that, I think the Fed's going to have no choice, given that one of their mandates is full employment, is they're going to have to try to reliquefy markets once again. So then you're going to have stagflation in this country on steroids, like we have never seen before. That is my prediction. So stagflation, disinflation, deflation, and then stagflation, all in a very short period of time. That's why active management really counts. I mean, if you just want to buy gold and get set for 2023, 2024, when the Fed admits that they can't, they'll be like Japan. Hey, Kuroda in Japan says, listen, I don't care what the ECB says. I don't care what Jerome Powell says. I don't care what Madame Lagarde says. I am never going to allow my 10-year note to rise above zero. He said, I'll print as much money as we need to keep interest rates at zero. Well, that's where I think Europe and the United States is going to end up in 2020.
Given that we've had some areas of the market, the stock market, that have done particularly well over the last number of years, which areas do you think that are actually going to be hit first and hardest?
Well, it's not really a guess of mine. I mean, I made the prediction, it's already happening. So you think of any high-tech company or any very high volatility company that's having a problem generating revenue and earnings, promises of future cash flow, way off in the future, they've been hit the hardest. So what I've done in my portfolio is I sold all those companies in 2021. I then I have a short position in the portfolio of around 13%. I've shorted some parts of the market, also shorted junk bonds. The only longs I have in the portfolio are the defensives. So you think about utilities, consumer staples, think about that. I've started buying treasuries as a hedge as well. And because I think, like I said before, most of the hawkishness of the Fed as far as interest rates are being priced into the market, but QT is not at all priced into the market. QT will actually bring down interest rates because it's deflationary, you're draining money supply. And I also have, for the first time in a long time, increased my position with gold to, I think we're close to 15% in the portfolio after being almost completely out since of August of 2021.
Wow, that's significant, isn't it?
Well, I mean, it's significant. It's significant because your performance will be a lot better if you don't just set it and forget, or have a set it and forget it portfolio, buy and hold portfolio. Doesn't work. I mean, buy and hold what? Are you going to buy and hold a group of stocks and bonds when both stocks and bonds are in a bubble? Your bond ballast has gone away. You think about, well, in past times, well, in 2008, my equity portion dropped 50%, but I did really good on my bond portfolio. Well, where are bonds going to really go when they're in the biggest bubble we've ever seen in the history of mankind? I mean, how much lower can yields really go? Even if I'm right on my bet on bonds, I mean, the 2-year note to the 1 to 3 year treasury is only yielding 1.5%, around that. I mean, it's not going from 5 to 0. It might go from 1.5 to 0. So you're going to make a little bit of money. I agree on that. But is that going to offset your 30 to 50 to even possibly 80% loss in the stock market, depending on what the Fed is able to engineer? Because here's the danger. I mean, this is important. I said the Fed's going to try to reliquefy the market. I believe they absolutely will after the credit markets freeze and after they, once again, because they failed every time. Every time the Fed tries to change its monetary policy and fight inflation, every time in the past they failed. And this time isn't going to be any different because all the conditions are much worse. Asset bubbles are greater, debt levels are much higher. So of course they're going to fail again. But every time they failed to engineering a soft landing, the market has crashed, of course. But if they try to reliquefy markets this time, they're reliquefying them from an inflation rate that is 7.5%, not 1.5 or below their 2% target. So my thought process is, well, what is the market's reaction to the Fed assenting to the notion that they can never fight inflation? How high do long bonds then go in yield? And will that inexorable rise in yields depress stock valuations for perhaps many years or a decade or longer?
So there are there are significant implications when they go to reliquify the markets this time or next time around that weren't there before when you had inflation fairly benign. Inflation at 7.5%, there are some consequences to doing it now. Or what I mean now is the next time they will do it.
You said it perfectly again. See, if your inflation is below your target, then the calculation from the Fed is, well, the credit markets are frozen and the stock market's in free fall. What do I have to lose? I'll just try to, I'll just go into QE, low interest rates, because after all, inflation is, quiescent. But when inflation is 7.5%, the calculation is different. You just can't easily say, okay, well, guess what? I'm going to reliquify the markets. That's a big problem.
There are other responsibilities at that stage. Obviously, most people that watch this channel have an interest in precious metals and in particularly gold. Now, you said that you've increased your holding in your portfolio in gold up to 15%. Maybe you could explain exactly why it is that you hold or choose to hold gold in your portfolio in this particular scenario.
So gold, in my mind, has never been a pure inflation hedge. It's never been a flight to safety from geopolitical risk. I care if Putin invades Ukraine, but for other reasons other than gold. For me, I own gold when I think real interest rates are going to fall.
Okay.
So real interest rates fall when nominal rates fall faster than inflation falls. So that's exactly what I predict is going to happen. I predict that the Fed is going to have to come in and try to cap the rise in long-term interest rates after they reliquify the system that we just talked about. Fed's going to say, listen, we cannot allow long-term rates to rise inexorably. So what does that mean? They have to expand their balance sheet again, create a whole bunch of inflation, which means nominal rates will rise much slower, perhaps, but much slower than inflation, which means real interest rates will fall. And the best thing for gold also is when nominal rates fall, but not as fast as inflation, as I just mentioned. So I believe, and my investors are on board, in this belief that we have a massive growth shock coming in the United States. We have a fiscal cliff that we're going over. We have a monetary cliff that we just talked about. We've got inflation at a 40-year high. Real incomes are falling. If you add all those things together, just in the fiscal cliff, I'll let you know that that fiscal cliff is the biggest we ever had since World War II. So we're going from 18% deficits to GDP to something more like 5% deficit to GDP, which is wonderful. I'm happy about that. The rate of change is wonderful, but the Fed was monetizing that deficit. So it was handing free money to people. So you have a big boost in nominal GDP, which is not going to be there anymore. So that's part of the growth scare that I see happening. So fiscal cliff, monetary cliff, inexorably rising interest rates, inflation, falling real income. So that all that spells and by the way, the base effects, I didn't even talk about the base effects. So you look at, earnings growth in the United States in 2021 was 45%. It's going to be 45% to say 5%. What a rate of change plunge that is. So all that's going to happen this year, which leads me to believe we're going to have the biggest growth scare we've ever had since World War II.
Wow. So 45 down to 5%.
Earnings, yeah, on the S&P 500.
That's, yeah.
By the way, that 5% is optimistic on my part.
Okay.
If the Fed prosecutes its efforts to fight inflation, like I think they're going to do until they wreck something, then you can actually have negative earnings in 2022.
Where do you think the retracement in the stock market can get to if all of these things come to fruition?
Well, a good thing about my models, it just tells me when the rate of change is going to plunge. So all I know is it's going to be down. I don't know if it's going to be 25, 30, 50, 80. It all depends, as I said, it depends on when the Fed tries to reliquefy the system and how effective they are at capping long-term interest rates. So here's a range for you. I believe that we could lose between 30 and 80% in the stock market in the major averages this year. That's a prediction. I mean, you're already down 11 or 12 on the NASDAQ. So it's not, it's not that outlandish. So, but once you have some of these major companies like Apple start to get sold, because listen, there's a lot of people with a lot of gains in Apple, and Apple is in so many ETFs. You sell Apple, and the ETFs have to redeem their shares because you have sales from the ETF. They sell Apple. It's a vicious cycle. The ETF goes down, you have to sell Apple. Apple goes down, you have to sell the ETF. I mean, you can get a panic in these ETFs like we've only seen. We saw it before, actually in 2018, the fall of 2018, when the Russell lost 30% of its value in a matter of a few weeks. So I'm looking for something like that to happen again. What were we doing in 2018? Talking about raising interest rates to 2.5% to 3% and talking about quantitative tightening.
Talk to me. Does silver play a role in your portfolio at all, or do you just focus on gold when it comes to precious metals?
Silver does play a role, but not right now. So for me to buy silver, I have to have globally coordinated growth. Silver has a monetary component and an industrial component. So I tend to shy away from silver when I think global growth is going to slow. And there's no doubt in my mind that global growth is going to be severely injured in 2022. So I'm going for a pure monetary metal, which has very little industrial use. It's just pure and honest money, and I'll stick with that.
I put you on the spot here, Michael. Given everything that you've said about what you think the Fed is going to do, if you were sitting in Jerome Powell's seat, what would you be doing now?
Well, I've been asked this question before when I used to be before I was canceled on regular TV. I was on CNBC. Larry Kudlow asked me this question. Not Jerome Powell at that time. It was Bernanke. And I said I would resign. I would resign and say, okay, this is the experiment in a 100% fiat currency has failed miserably. We destroyed the economy and destroyed the middle class over and over again. So this is what we're going to do. We're going to either go back on the gold standard or limit the growth rate in base money to the natural increase of the labor force plus productivity, so GDP. So think about 1.5% to 2% annual increase in potential GDP. So a 1 or 2% increase in the base money supply, and let markets decide where interest rates should be. The supply of savings versus the demand for money. How about let markets work? Let the market figure out where home prices should be. And they shouldn't be up 80% year over year in Florida or 20% year over year all over the country. It doesn't make any sense. Let the market decide where where equity should be. Let the market decide which companies deserve to stay in business and which should go the way of the dodo bird. Because you shouldn't have companies being able to borrow money for free just to borrow money so they can pay interest on outstanding debt. It's not a good proposition. So that's what I would do if I was Jerome Powell.
So
since he's not going to do any of those things, Dave, I would at least feign an interest immediately. Today, I would make an announcement. We have ended QE. This is our plan for quantitative tightening. We're going to shed $2 trillion of the balance sheet between now and the next 2 years. We're going to do $100 billion a month or so, $80 to $100 billion a month, and we're going to raise interest rates to 2% by the end of 2023, no matter what happens.
So
let markets function freely.
He's going down in flames, but you want to see him go down fighting at least. Is that it?
I would like him to admit that he doesn't know more than the market. And what is the market? It's the ability, it's giving millions and millions of individuals the freedom to do what they want with their money and vote with their money what they want to do with it. That's the market. And the market hasn't been allowed to function since 1971. And it's been obliterated under this regime, under Jerome Powell. Obliterated.
So we need to bring back some sort of monetary discipline, something that keeps central bankers disciplined and lets the market dictate where capital should be allocated.
Well, there's no better fettering mechanism to accomplish that than to go back to a gold standard, because guess what? The mine supply of gold just happens to tend to increase about the same as growth in the labor force and growth in productivity. So, and guess what else, Dave? If there's a mild or slow deflation that occurs, it's okay. There's nothing wrong with you running around with money in your wallet saying, hey, look at the purchasing power of my money. It's getting stronger.
That'll be a nice feeling.
It encourages me to save. I like to save money. You know, what's wrong with that? Is there anything really wrong with that? I mean, this country was built on a slight deflation, disinflation, not disinflation, deflation. The whole entire industrial revolution during that time, that golden age, was built with the gold standard and fettered money supply growth tied to gold. I mean, after all, I think Jerome Powell should admit to this. Money should mean something other than a couple of keystrokes on a computer board.
Absolutely. Michael, before we wrap up, can you tell the viewers of this video where it is that you hang out online and where they can learn more about what it is that you do?
So the website is pentoport.com. If you are a U.S. citizen, you can open up an account if you have around $100,000 to invest. If not, if you're a foreigner and you want access to my ideas, you can always subscribe to my podcast. It's $50 a year. It's called the Midweek Reality Check. And it gives you a lot of good data, a lot of independent analysis without an agenda about what's really happening, and some really good ideas on, where I think the economy and markets are headed.
What I'm going to do is I'm going to put a link to both of those things in the show notes in the description below this video. And I hope you come back and join us again, Michael. But for now, thanks for joining us on GoldCore TV today.
Thanks, Dave.
Thanks for watching. If you enjoyed this video, you're bound to enjoy these interviews that I did recently. One of them with Rick Rule and the other with Jim Rogers. Go watch them next. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.